when it comes to the regional bank stresses, you have portfolio companies that banked at SVB. You also have a portfolio company that offers an alternative to services that was offered by SVB. Can you tell us, share with us what you learned as a VC partner in regards to what happened in mid-March for what it means for the future of e-banking?
Yes, sure, Scarlett. Thanks for having me. Mid-March was a stressor for early stage companies, many of whom banked at SVB. But I think one thing that's really important to remember is this wasn't a crisis of the tech industry. The changes that regional banks are experiencing are really driven by the rise in interest rates and inflation and are a balance sheet challenge for these regional banks like SVB and First Republic. So the small companies, technology companies that bank with them, many of those companies that had their assets consolidated in one bank obviously went through a very stressful time thinking, for a moment over that weekend in March that their assets might be in danger. So at M13, our portfolio was actually in pretty decent shape because we had been recommending for a while that banks diversify their funds across multiple banks. And in fact, we have one, as you mentioned, in our own portfolio called Row, which is a fully integrated banking, credit, and expense management solution targeted at small companies. And so for the companies that hadn't previously diversified, it was an opportunity for them to do so. And one of the interesting things about Row is that its underlying banking partners are themselves a diversified collection of banks. So I think, I've said the word diversification here many times. I think the message we've tried to really, hammer home with our portfolio is diversification over where you're keeping your assets, with Row being one great option that we've recommended to our portfolio and to other startups.
Anna, you said that the SVB implosion was not a technology industry crisis, but it became one after the fact. It's become a little bit of an uncertain time in the investing world. VC dollars aren't flowing in at the same rate as when rates were lower and money was easy to go around. As you're having conversations with your portfolio companies, with your prospective portfolio companies, I'm curious if you could give us some insight from them. In this uncertain time, what are they really looking for in terms of who they surround themselves with? Obviously, picking a partner like SVB ended up being a tricky situation when it comes to who they're putting their money with and also the venture partners that they're bringing into their boardrooms. What are you seeing these days?
You're absolutely right. So the challenges that SVB has faced are also presenting challenges for early stage technology companies. The main thing happening is that the access to capital for startups has changed dramatically from what it was a couple of years ago. And also the operating environment has changed. So where 18 months to 2 years ago, startups were all getting the message that capital was readily available, both equity and debt capital. And that growth at all costs was really what we were looking for from them. Now startups are getting a very different message, which is about profitable growth, about proving that you can get to cash flow break even. And we're now in an environment where cash is harder to come by. Investors are more conservative. Although I will say what we're seeing really is just a return to the investing climate of, say, 2018, 2019. If you think about what the anomaly is, it's not what the environment we're seeing today. The anomaly is really 2020 and 2021. When you can look at the rate of venture investing and the high valuations that we saw as really an exception to the rule and maybe even a bit of a bubble. So when you think about today, what is it that founders are looking for, entrepreneurs are looking for? They are looking for, obviously, capital, and we are recommending that companies look to be capitalized 2 to 3 years so that they have time to grow without being distracted by needing to go raise additional capital. And they're also looking for investors that have experience and expertise to help them get to the next stage, which is why this is a great time for a firm like ours at M13. We have a lot of partners who've been through previous downturns with a lot of operating experience who have kind of weathered previous storms. I was an operator in 1999. I went through the dot-com bubble. I was actually an executive at petstore.com, which, if you've studied the history of the internet, was a really interesting case study. And same with my other partners, lots of people with a little bit of gray hair and a lot of experience to help our portfolio get through this rocky time.